If I told you that the stock market, a place where trillions of dollars move every single day, was actually born from fear, blood, and a level of risk capable of wiping out an entire family in a single night, would you believe it? We live in a world where money can multiply through pieces of paper. But to understand how that became possible, we have to travel back more than 400 years to a tiny country with no vast empire, no mountains of gold, no mighty army, yet it created the invention that reshaped the entire global economy. At that time, Europe was locked in feudalism, and the Dutch faced a brutal question. How can a small nation, drained by war, afford voyages so dangerous that one storm could sink a lifetime of wealth? The answer they forged would eventually become the backbone of modern capitalism. The story you're about to hear isn't just the origin of stocks, it's the origin of power, greed, belief, and the moment when money broke free from labor and began multiplying on its own. Every market, every bubble, every financial crisis we know today all traced back to that moment. To understand why the Dutch sparked such a financial revolution, we need to return to 17th century Europe, a continent fractured by war, feudal rule, and empires fighting for dominance. Spain and Portugal fueled their armies with gold and silver from the New World. France and England still believed power came from land and royal bloodlines. And then there was the Dutch Republic, a small nation with no gold mines, no vast colonies, and no powerful monarch, drained by a brutal war against Spain. They had no natural riches to exploit and no king to rally behind. What they did have were the sea, storms, and a population forced to become daring simply to survive. In this setting, the Dutch viewed the world through a radically different lens. Power didn't come from territory or thrones, it came from trade. It came from ships crossing dangerous oceans, from contracts forged between merchants, and from turning risk into profit. They watched other nations grow wealthy from spices, silk, and eastern riches and asked themselves, if we cannot conquer land, why not conquer commerce? That shift in mindset changed everything. While the rest of Europe tied their wealth to soil and aristocracy, the Dutch built theirs on calculation, cooperation, and the ability to stretch every coin by sharing risk. And from this bold cultural DNA emerged a revolutionary idea. Instead of staking an entire fortune on a single voyage, they would break that risk into pieces that anyone could buy. From this worldview, the earliest seeds of the stock market were planted. Before the stock market existed, every ocean voyage was a gamble, and most gambles ended in loss. Sending a ship out of Amsterdam in the 17th century meant accepting the brutal truth that a single storm, a sudden outbreak aboard, a pirate attack, or even a decree from a hostile empire could erase an entire fortune overnight. There was no insurance, no rescue operations, no radio transmission to call for help. Once a ship disappeared beyond the horizon, no one knew whether it would return with treasure or vanish forever. The risk wasn't just high, it was absolute. And that absolute risk paralyzed ambition. Even the wealthiest merchants didn't dare put their entire fortune on a voyage where survival was no better than flipping a coin. One failed ship could destroy a family dynasty. One disaster could turn a respected merchant into a beggar overnight. This fear strangled the rise of the Dutch Republic. They had the skills, the ships, and the opportunity, but they lacked a way to spread the danger. A nation that dreamed of global trade found itself trapped because no individual was reckless enough to bet everything on a journey no one could control. Risk, not money, not ships, not cargo, was the real obstacle to Holland's expansion. And when Europe believed that risk was an unbreakable wall, the Dutch asked a different question. If the danger is too great for one person, why not divide it among thousands? That question became the spark that transformed global finance. While Europe believed only madmen would gamble with the open sea, the Dutch approached the problem from a completely different angle. They didn't try to make voyages safer, nor did they attempt to eliminate risk. Instead, they did something revolutionary. They broke the risk into pieces so small that anyone could carry it. Rather than forcing a single ship owner to stake his entire fortune on a voyage that might never return, they divided the cost of a ship into thousands of tiny portions and offered each portion to merchants, craftsmen, shopkeepers, and even ordinary citizens. Each person contributed only a small amount, small enough to survive losing, but large enough to hope for a share of the profits if the ship returned safely. And in that moment of brilliance, something extraordinary was born. They share a tiny slice of a massive venture, a ticket to participate in future profits. Yet, with a level of risk that even a common citizen could accept. For the first time in history, danger was no longer the burden of one, but the shared responsibility of many. A single ship sinking would not bankrupt a family. It would merely reduce the wealth of thousands by a small fraction. And if the ship triumphed, the reward would be distributed according to the number of shares each person held. This was not merely a financial solution, it was a mental breakthrough. Because one's risk can be divided, it can also be traded, it can be transferred, it can be priced. And most importantly, it can scale into an entirely new system, where wealth is no longer limited by the pockets of one individual, but can be built by the collective resources of society. This was the true birth of the stock market, not from paperwork, but from a daring idea. If one person cannot bear the risk, let thousands share it. Once the idea of dividing risk proved its genius, the Dutch didn't stop at financing individual voyages. They scaled the idea into a massive economic machine by merging fleets, capital, and merchants into a single entity, the VOC, the Dutch East India Company, the first joint stock corporation in human history. This wasn't merely a company, it was an empire built from the pooled savings of tens of thousands of ordinary citizens, all contributing to one goal: controlling global trade. By allowing anyone to buy shares, the VOC became the first doorway for common people to own a fraction of a vast enterprise that stretched across oceans. But make no mistake, the VOC was no democracy. Real power didn't belong to the small shareholders. It concentrated in the hands of a select council known as the Harem of 17, the 17 gentlemen, who dictated everything: shipping routes, military campaigns, commodity prices, and even wars and treaties. Ordinary investors provided the money. The VOC used it to build its own navy, establish colonies, impose taxes, control ports, and in many places operate with more authority than national governments. It was the moment the world witnessed a new truth. A company could be richer and more influential than a country. Shares allowed the VOC to raise unimaginable amounts of capital, and with that capital, it dominated trade routes from Asia to Europe. Citizens bought shares to access profit, but VOC's leaders held the company to access power, and this blend public capital under private control became the blueprint for the modern corporation. Every major company today, every stock exchange, every system of public investment traces its roots back to one groundbreaking idea. If tens of thousands of people fund a single enterprise, that enterprise can rule the world. The birth of shares didn't just help the Dutch finance voyages, it opened an entirely new era, the era where money no longer depended on human labor. Before this moment, wealth came from land, resources, or physical work. But with the invention of the share, people could earn money simply by owning a slice of expectation in a business they never set foot in. A small piece of paper could generate profit without requiring a single hour of labor. Ownership separated from control, and profit separated from physical effort. This changed everything. It created a new class of people, those who didn't work directly, yet earned from the labor of others. It opened a divide between capital and labor, a divide that has only grown wider over centuries. Most importantly, it introduced a radical idea about value. Value was no longer tied to what you held, but to what people believed it was worth. A share could double in price simply because someone expected it to. Money detached from material goods, risk became tradable, and expectation, the most intangible thing of all, suddenly became the most powerful commodity. From that moment on, economies were no longer built solely on land or tangible wealth, but on psychology, belief, and capital flows. This was the true foundation of the modern financial world, a world where money doesn't have to come from labor but can multiply from the expectations of people. As VOC shares spread across the Netherlands, a fascinating shift occurred. People no longer wanted to wait months to learn whether a ship had sunk in a storm or returned with a fortune. They wanted to trade immediately, sell shares when they needed cash, or buy more if they believed the next voyage would be profitable. This simple human desire gave birth to something unprecedented, a place where ownership could be exchanged without ever touching the real asset. That place was the Amsterdam Stock Exchange, the first in the world. Here, everything changed rapidly. Fishmongers, shoemakers, merchants, tavern owners all could gather to trade VOC shares. There was no need for the ship to return or for anyone to see the cargo. Prices moved based on rumors, expectations, and emotion. For the first time, people weren't investing in the ship, but in the behavior of other people. If they believed many would buy, they bought early. If they sensed fear, they sold instantly. And in that moment, a new concept emerged: speculation. Share prices no longer reflected the fate of the voyage, but the collective fear, hope, and herd psychology of society. Investors didn't care if the ship reached its destination. They cared only about who would buy next and at what price. From that moment on, the stock market became more than a tool for raising capital. It became a giant stage where every participant tried to predict the next move of everyone else. It was the beginning of a new kind of game, one we are still playing today, often without fully understanding the rules. The birth of the Amsterdam Exchange unlocked a phenomenon humanity had never truly encountered before. Prices could rise not because something had real value, but because the crowd believed they would rise. And the clearest, most dramatic example of this was tulip mania, the 17th century obsession, where a single flower became the ultimate symbol of wealth, vanity, and unchecked speculation. It began with curiosity. Rare tulip bulbs from the Ottoman Empire arrived in Europe, and their unusual colors captivated the elite. But beauty turned into fashion, and fashion turned into a market. Merchants started buying tulips not to grow them, but to flip them at a higher price. Ordinary people heard stories of prices doubling weekly, even daily, and the fear of missing out pushed them into the game. They sold land, mortgaged homes, emptied life savings, all to buy a bulb that hadn't even bloomed, and as long as the crowd believed prices would rise, they did. At the peak, a single rare tulip was worth as much as a large house in Amsterdam. A flower fragile, perishable, became Europe's most expensive luxury. But the real danger wasn't the price, it was the belief behind the price. People no longer cared about the flower at all. They only cared about who will buy next and at what price. At that moment, the market detached completely from reality, and a bubble, a literal one, inflated from a simple bulb. But like all speculative bubbles in history, it couldn't grow forever. A whisper of doubt, a rejected bid, a moment of hesitation, and the illusion collapsed. Within weeks, prices plunged from astronomical to almost nothing. Bulbs once treated like treasures were suddenly worthless. Those who mortgaged their homes to speculate lost everything. An entire society stood stunned. Tulip mania became the blueprint for all future bubbles, proof that humans will abandon logic to chase what they don't understand as long as they believe someone else will pay more. What made tulip mania legendary wasn't how fast prices rose, but how fast they collapsed. One morning in early 1637, during a small auction in Haarlem, something seemingly insignificant happened. A buyer refused to bid higher for a tulip bulb, just one hesitation. But that tiny moment pierced the massive bubble inflated by the hopes of thousands. Rumors spread like wildfire. Someone backed out. Prices have peaked. Sell before it's too late. And overnight, what had been a luxury asset became a burden no one wanted. People rushed to sell, but there were no buyers left. A bulb once worth a grand Amsterdam house couldn't fetch even a fraction of its former price. Futures contracts imploded. Families who mortgaged their homes were ruined, and entire fortunes evaporated because people chased an illusion. Tulip's collapse wasn't an accident. It was a blueprint for every future bubble. Markets don't run on logic, they run on collective belief. When belief rises, prices soar. When belief breaks, nothing can hold them up. Tulip mania ended not because the flowers lost beauty or supply suddenly increased, but because the crowd finally realized they were buying a story with no substance. And when the story died, so did the value. That was the day Europe learned a timeless lesson. In finance, belief can create wealth and erase it in a heartbeat. Tulip mania wasn't just a moment of madness, it became the blueprint for every financial bubble over the next 4 centuries. The Dutch may have invented exchanges, shares, and the first structures of modern finance, but their greatest legacy lies in a simple truth. When greed grows faster than reason, markets turn into illusions. From that moment on, history repeated itself with new names. The South Sea Bubble of 1720, where an entire nation bet on a company built on promises. The 1929 crash, when stock prices soared only because people believed someone else would pay more. The dot-com bubble of 2000, where companies with no profit and barely any product were valued in the billions because the future will be bright. The 2008 housing crisis, fueled by blind faith that real estate could only rise. And in recent years, crypto spikes, NFT manias, and meme stock frenzies where value isn't in the asset, but in the psychology of the crowd. The forms change, but the pattern doesn't. Curiosity, enthusiasm, euphoria collapse. Like tulips, modern assets are priced not by what they are, but by the stories people wish to believe. When the story is strong, prices rise. When the story breaks, everything evaporates. This is the true legacy the Dutch left behind. They didn't just create financial markets, they accidentally revealed their vulnerabilities. And every generation since has had to relearn the same lesson the Dutch discovered 400 years ago. You can build wealth on belief, but you can lose everything to that same belief. Looking back from a 17th century tulip bulb to today's multi-trillion-dollar global markets, we realize that finance has never truly changed, only the scale has. Technology evolves, instruments grow more complex, but human psychology remains exactly the same. Belief once turned a flower into something worth more than a house, just as belief today can transform a profitless startup into a billion-dollar giant, or send a digital coin skyrocketing simply because its story sounds irresistible. Modern finance stocks, derivatives, investment funds, cryptocurrencies, algorithmic trading ultimately revolves around one thing: a marketplace of beliefs being traded every second. And just as the Dutch discovered centuries ago, markets don't measure real value, they measure the strength of collective expectation. When expectation rises, prices rise. When expectation breaks, everything falls apart faster than anyone anticipates. This means that those who understand how belief moves understand how markets move. And those who don't, no matter how intelligent, are swept away by the same recurring waves of greed and fear. Tulip mania was not just the first speculative bubble, it was a mirror reflecting every financial behavior we see in the 21st century. From meme stocks to crypto, from startup frenzies to real estate booms, everything follows the formula the Dutch accidentally revealed. Prices don't rise because something has value, they rise because people want to believe it has value. In the end, the lesson isn't to avoid risk or fear the market, but to recognize that perception is the most powerful force in finance. The question isn't, where is the market going? But what belief are you following and where is it taking you?